Good day fellow traders and value investors, and welcome back to another video. Today we continue a series start with ACE, and today we'll look at Shopify. Shopify stock price exploded. The chart looks strong, the trend is up, and on the surface everything looks right. But here's the thing, when a stock looks this good, that's usually when investors stop asking the most important question. Because while Shopify's price is going up, the valuation is telling a very different story. Now I'm not here to tell you Shopify is good or bad. I'm here to answer a different question. What is the market already pricing in, and what actually has to go right from here? We'll look at the intrinsic value scenarios, the risks, and technical levels that actually matter right now. By the end, you'll know whether this is a trend you follow or a price you wait on. Let's get into it. So let's start with what Shopify actually is. At its core, Shopify helps merchants do three things: start a business, run day to day, and scale it as sales grow. And here's the key part. Shopify doesn't just make money when you sign up. It makes more money when merchants make more money. It has two revenue engines. Subscription solutions. Merchants pay monthly fee to use Shopify's platform. Everything from basic plans all the way to Shopify Plus, which is designed for large, high volume businesses. This bucket also includes things like apps, themes, and domains. The second engine, Merchant Solution, is now the real growth driver. This is the usage-based side of Shopify. Instead of charging a flat fee, Shopify takes a cut as merchants process payments and move more volume through the platform. And understanding how this business is making money is important before we even talk about valuation. Now that we know what Shopify is, let's talk about what the business is doing right now. Revenue is growing fast, GMV is climbing, and free cash flow is pretty healthy. We'll start with GMV. GMV stands for gross merchandise volume and is the total dollar value of all goods sold through stores on Shopify platform in a specific time period. GMV is important because it tells us if merchants are selling more through Shopify. And in the latest period, GMV was strong, roughly in the 30% area, from 69 billion to 92 billion. We'll now look at the financials in trading view as well, and we'll follow the numbers in here. First is the revenue growth. We can see that it's been growing double digits over the last several quarters. If we scroll down to the net income, however, we can see that there is negative income growth in Q1 2024 and negative income in Q1 2025 and negative growth in Q3 2025 as well. And the reason behind this negative growth is the non-operating income. If we expand in here, we see unusual income and expenses, and we see how it's been negative in Q1 2025, it's been negative in Q3 2025, and then obviously Q1 2024 as well. What this means is that the company owns equity in other companies, and the value of that equity, the share prices of those companies that they own, went down, and they registered a loss. I'll clean the face and we'll go to annual. We see one interesting thing as well. We see steady growth year over year, trailing 12 months of 10 billion, and we see the revenue growing from 1 billion to 10 billion. That's pretty healthy growth, but again, not the same can be said about the net income. We can see negative net income in 18-19, and then the net income was growing, and then negative net income in 2022, and then is back on the growth again. 2022 drop is again due to the unrealized unusual income and expenses. They had a negative 3 billion of unusual expenses, and that again is due to their unrealized profit on their equity or the equity they own in other companies. So basically in 2022, not only did they had to cut costs, but they also lost money because of their investments in other equity. So this is a risk for me. This is something to bear in mind further. I didn't include this in the risk section, but this is something to bear in mind. Company owns equity in other companies, and when those companies do bad, Shopify will do bad as well. We'll switch to the balance sheet, and what's interesting is that they have negative net debt. And what it means is that they have more cash and short-term investments than they have total debt. We can see that they have cash and short-term investment of 5.48 billion compared to the total debt of 1.13. Deduce that and you have negative 4 billion. That's a pretty positive position. And as we've already discussed, free cash flow is growing steadily currently sitting at 1.91 for the trailing 12 months. We'll switch to statistics and we'll look at the annual. We can see that the company is currently selling for a PE of 124. The way that I look at the PE is that it will take you 124 years to return your $1 invested today in the company. Another way to look at it is that investors are happy to pay $124 for $1 over earning today. And as we can see in the past, the company has been selling for quite high PEs. We scroll down and we look at the gross margin. We can see the gross margin has been in the 50 pretty much all the time. It's never been higher than that or lower than that. So if you have a position in the stock right now, it's important to keep an eye on the gross margin. If gross margin drops, it means that the company is paying more losses, is making less money on the fees. So that's something to keep an eye on. And then we can see that net margin has been up and down and all over the place. And in 2021, the net margin was positive 63, only to drop in negative 61, and that's because of their equity unrealized loss. And then net margin is currently growing again, which is a good thing to see. We'll scroll further down and we'll see that the company has a pretty healthy current ratio of nearly 3.93, which means that they have nearly $4 of current assets for every $1 of current liability. They should not have any problems paying their suppliers. Pretty healthy debt to equity, as we've already discussed, of 0.09. I like to see a maximum of 0.5. So as we can see, Shopify is a financially healthy company with strong revenue and cash generation. We now need to look on how much of that is already priced in. So now here's one answer to the most important question. We're looking at the three calculators, Warren Buffett, Phil Town and Peter Lynch's calculators, to answer how much should we pay now for the stock. According to Warren Buffett's calculator, the stock is valued at $204 per share, and this calculator is using the book value per share, current and the one of 10 years ago, compares that to the 10 years bonds. According to Phil Town, the stock should be selling for about $82 per share. Phil Town's calculator is using EPS growth. I used a growth of 15%, as that's pretty much what was the consensus. Over the next 5 years, the company was projected to grow at 20%, which is pretty optimistic. So I use a more conservative 15% growth. And according to that, the stock should be selling for $82 per share. And then using the Peter Lynch calculator, we can see that we get a rating of overvalued. So as we can see, according to these calculators, we get a fair value of $82 to $204 per share. And with the stock selling at 164 at the time of the record, and we can see we get just a little bit of margin of safety. Now turning to the 3 case scenarios, I use the Merchant Solutions profitability as the key driver for my calculations. And I use these PEs because in a PE of 30 is in line with high quality payments platform. A PE of 40 is premium to peers still, but justified by platform ecosystem and strong cash flow. And a PE of 55 is roughly matches Shopify's best clean profitable years. So in a bear case scenario, if we see EPS growing at 12%, GMV slows, payments and loan losses rise, we could see EPS of 240 in 5 years and the stock could be selling for 71.90. In a base case scenario, with EPS growing at 20%, Shopify roughly matches long-term expectations. Payments penetration continues improving and management says that it's currently at 65%. We could see EPS growing to 338 in 5 years and the stock could be selling for 135.36 in 5 years. And in a bull case scenario with EPS growing at 28%, Shopify sustains strong GMV growth and expands profitability. Loss rate stays controlled while payments scale. We could see EPS of 467 in 5 years and the stock could be selling for $257. Putting it all through a probability weighted table, we can see that we get negative return in bear case scenario, negative return in base case scenario, and only positive return in a bull case scenario, with a total 5 years return of negative 9%, which makes it annually of negative 184. Pretty risky if you ask me. So there you have it. We have a fair value range between $72 per share and $257 per share and negative compounded annual return. When a stock is trending this well, the risks don't disappear, they just get quieter, and Shopify is no exception. The first risk lives right inside Shopify's biggest growth engine. Payments are driving revenue higher, but they also come with problems. Fraud, chargeback, and losses that rise as volume rises. We can see that they are up 155% quarter over quarter and 100% over the 9 months. Second risk is lending, merchant financing. The loan book is now large, sitting at 1.73 billion. More lending can boost revenue, but in recession small merchants default more. By the time the damage shows up in the numbers, the stock has usually moved already. Third risk is competition. Shopify competes with Amazon's ecosystem, BigCommerce and Wix on the softer side, and custom enterprise solutions at the high end. And finally, consumer spending risk. If consumer spending slows, merchants sell less. If merchants sell less, GMV slows. And when GMV slows, Shopify's largest revenue stream is slow with it. The business doesn't collapse, but expectations start to reset. Now, none of these risks mean Shopify is a bad business, but together they explain why valuation is important. Now let's bring price into the conversation, because fundamentals tell us what to buy, but charts tells us when. And right now, Shopify charts tells us the stock is in a long-term uptrend. We can see higher highs and higher lows. Just clean the face as well. We can see that the price is also holding above the moving averages 21, 34 and 55, which also confirms the uptrend. Now let's zoom out a little bit and look at a few key areas of support and resistance. We see that the 30 area was a strong support and resistance area. The price broke through it once and rallied all the way to about 170 zone, where it found resistance, and then we can see what happened during the 2022 when the margins have dropped. The stock rallied all the way back to the same $30 per share zone, where was the net margins reset when the stock recovered a little bit, and then we see that ever since it's been moving into an uptrend. We'll zoom back in as well, and then we can see that over the past year or so, past couple of years, every meaningful pullback has been bought and the stock rallied higher. Pullback, rallied higher. And then it finally found some more resistance at the same $170 per share. Cleaning the face again, and we can see what happens right now is that the stock is no longer moving with high momentum upwards. It found some resistance in here, and it's possible that it will move sideways. We can also see that on the MACD-V and the signal line are below the 50 now, and they are no longer signaling high momentum upwards. We can see that the momentum has cooled down a little bit. We can also see that the histogram is currently in the red. So technically Shopify is still in an uptrend, as long as the price holds above the ATR dots, above the moving averages, and as long as every pullback keeps being bought up, the trend remains intact. So let's bring this full circle. Shopify is doing a lot of things right. The business is evolving, merchants are selling more, and the long-term trend in the stock is still firmly intact. There's no debate about that. But this video was never about whether Shopify is a good company or not. It was about whether the stock price already reflected a near-perfect future. Right now, the market is pricing Shopify as if growth remains strong, margins don't disappoint, payments and lending risks stay contained, and new channels like AI-driven commerce actually deliver incremental upside. That doesn't mean Shopify can keep going higher. It just means the margin for error is thin. At these levels, the stock doesn't need bad news to underperform. It only needs reality to come in slightly below expectations. And when you add this stretched valuation on top of a mature uptrend, the strategy becomes clearer. This is not a stock to chase blindly, it's a stock to approach with discipline. If you're already in the stock, this is about risk management and expectations. If you're not, this is about waiting for either a better price or stronger confirmation. And that's exactly how intrinsic value and technical analysis are meant to work together. If you enjoyed this analysis and found it useful, hit the like button, consider subscribing, and let me know in the comments below what stock you'd like me to analyze next on Fundamentals in Motion. Thanks for watching.